All right. So thanks, Professor Karmakar, for taking that attendance, right? It increased the number of people participating in the session.
Yeah.
Some things never change,
Otherwise,
right? That's fantastic.
what can take class, but still without attendance, they will not be present.
Yeah, some things never change. The proxies
Yeah.
continue. Huh?
Yeah.
That's good stuff. Okay. All right. So we will get started now with the second half of the presentation. And in this, we'll talk a little bit about how to invest in exuberant times or in challenging times. And what I want to do first is talk about the story of the 2023 to 2025. Obviously, 24, late 24 and early 25 was slightly different. But in general, these 3 years have been quite exuberant. So let's look at that. So first of the one of the challenges with these exuberant times is that fear of missing out is as much or as big a fear as a fear of losing out. And if you look in the last few years, actually, frankly, from COVID onwards, but 22 was a difficult year everywhere. And so therefore, I'm using 23 to 25. But in that period, again, is a perfect case study of how the sentiments change as people become more focused on fear of losing out or fear of missing out. So every day, what happens is the stock prices keep going up and it brings you further disconfirming evidence in case you are not invested. And the worst thing is that you're not invested, your friends are invested, they are making a lot of money, and you are feeling like an idiot. But in some cases, not all the cases, prices are not anchored to the fundamentals. So therefore, if the prices are not anchored to the fundamentals, then it is very hard to decide what to sell and when to sell. And so not only is it difficult to sell, but also it is difficult to deploy new cash because if you were to sell, what will you do with the cash? In good times, cash is seen as not giving much returns. And so people don't want to have cash. And in bad times, you only want to have cash because your equity holdings are going down. So really, it's a psychology that one has to understand. And if you do sell, as I said, you don't know what to do with the cash. So investor behavior is never changing. It continues to have the same cycle where they think that cash is burning a hole in their pockets when the times are good. Now, what we do in these times, when we think that the stock has become fully priced and rather it is going beyond fully priced, as in it seems unfairly priced, what we are trying to do is to start selling. But our approach is not to sell in one go unless something is moved up dramatically, but rather to sell slowly because that gives us the comfort whether we are on the right track or not. And it also reduces the imaginary cost of cash lying on the sidelines and not doing too much for us. Now, what stocks to sell? The way we determine that is based again on our expected return framework that I talked about. And anything which is fully priced will have expected returns that are far lower than the other opportunities in the portfolio. In addition, there might be stocks in our portfolio where our comfort with them has gone down over time because the business model is reflecting intense competition in that particular industry, or maybe the management has behaved in a manner which we think is not in the best interest of the shareholders. So it could be either fully priced or it could be where our discomfort has grown with that particular position. Similarly, as we are selling gradually, we are also deploying cash gradually. In general, what we find is that some of our existing holdings provide the best compelling opportunities for us. And if we are not finding anything which is very compelling, then we always are looking for new business models by either taking tracking positions or just keeping it on our watch list. And again, in our portfolio, we don't have any constraints about how big of a cash we can have in the fund. And many times people think, well, cash is not giving you much returns given what we have delivered in the past. And you can say that is the opportunity cost. We don't think so. We think cash is really valuable when the markets actually turn downwards, because at that point, everybody runs for the hills and we can actually go and buy some meaningful positions at compelling valuations. So, really, in exuberant times, going against the crowd, but not in one go, but gradually, and buying into things that you feel much more comfortable about is the best way to do it. And that is what we do. And this also sort of works well with our long term orientation, which is that when we are taking a position, we are thinking a few years out. And therefore, we are not too much worried of what is happening here and now in the stock market. Now, let's look at a little bit more of the COVID times and what happened in 2020 and 2022, which are times which are much more challenging. So, typically in those challenging times, what happens is higher uncertainty and, in general, many more potential downside scenarios. In general, what we tend to do then is to raise our hurdle rate for the expected return. We want to ensure that we will get good returns when we invest in any position. We also reevaluate our thesis on the various companies that we are invested in for many different factors, but the most important one is the resilience. And resilience, that if the stock price were to go down, how is the capital of the company? Do they have to raise new capital? How comfortable are we with the management? And our hurdle, not just on the return, but in terms of which management we are investing with and how the industry is also goes up. The hurdle goes up, which means we are demanding better businesses, better management, and better balance sheet. In general, we find that management incentives, as I said in the past, is a very good indicator of how the management will behave, not every quarter, but over the long term. And so we continue to want to invest in companies where the incentives are well aligned. In addition, when the market is going down, there's a lot of noise. And one of the important things one has to do is to filter out that noise. Even today, when we are talking about tariffs, there's a lot of noise. But irrespective, right now the markets are not necessarily down too much. But when the markets go down, the news media will give you a lot of news bites, which will make you scared. And the question then is to decide which one of those news media bites are real risks and which of those are just risk mongering, right? And one of the ways that you can focus on what is important is to think a few years out and not worry too much about quarterly impact, because quarterly impact and quarterly results at that point start becoming very ominous. The volatility, obviously, in these times goes up. And really, that is the time to take advantage of the stock market and not be swayed by it. So there are much more opportunities in difficult times or uncertain times as compared to good times, obviously. But one additional thing that happens is that the correlation goes up across various stocks. So everything goes down at the same time. And so when you have cash, you can take advantage of all the positions that are going down together and pick the best ones among them. The problem with correlation going up and everything going down together is that you cannot sell the worst position because everything has come down comparatively, right? But if you feel some of the positions are not as good, as I said, for various reasons, you can start upgrading your positions and getting into better businesses, better management with similar return profile. The other thing to remember in these uncertain times is that the investor's time frame shrinks. Because of the volatility, nobody's thinking a few years out. Everybody's saying, well, how much is my portfolio down today? Or how much is my portfolio down in the week or the month? or for the quarter, right? They don't want to go beyond that. But this is where, if you have chosen your investor well, that is not an issue, because we don't want to have a lot of calls coming to us when times are uncertain, asking us what does it look like or what will happen. So we try to, in good times, choose our investors well, so that when uncertain times come around, we are able to benefit from those. In general, the mistake most investors make with the stock price coming down is to think that, okay, the quality of the business is also coming down, equating the price of the stock with the quality of the business and the value of the business. It is at these times that the cartoon that I showed you becomes really handy. And you need to remember that stock price is driven by demand and supply, while the quality of the business is driven over a long period of time depending on the competitive intensity, and the two are not correlated. In addition, the focus of most investors, rather than focusing on individual companies, goes on to the macro. What will the RBI do? How much will be the tax rebate? What are the new government policies? Rather than focusing more on things that an individual or an investor can control, which is identifying good businesses. So, all the good work that you have done during good times becomes handy now, because now is the time when all the work can start reflecting in the positions, because you can now buy good companies at good prices. And that is why having some cash always is helpful in these uncertain times. So let me make it much more concrete by telling you our experience in 2020 COVID. And now this is not something that we did in the fund, because the fund started, as I said, in April of 2021. So this is the experience that I'm sharing you here, is experience in my own personal portfolio during COVID. Of course, this was a period where there was a lot of uncertainty, because really governments for the first time were shutting down economies, right? And this is a situation that most of us have never faced in our lifetime, where the governments are actively reducing the economic activity because they don't want the spread of the disease to increase. And there was no visibility of how any company will perform, right? Not only our company, but any company. So what did I do? So what I did basically is reassessed our portfolio companies to whether they can withstand 1 to 2 years of no or limited revenue. Because if you can withstand that particular period, and it was quite obvious that it won't go beyond a certain number of years, maybe maximum a year, right? Because it becomes very difficult beyond a point to sustain. And so what I try to do there is to ensure that the companies that I own, they have enough of capital on their balance sheet that they don't have to dilute us. And they will, even assuming no returns or no revenue and therefore losses for the first 1 or 2 years, still the expected return in the above scenario is quite meaningful. Once we identified those particular companies, we rotated capital from companies that were fully valued to companies which were much more compelling. And so this is something that many people don't realize, which is stock market is a huge advantage for listed companies, because I can sell any company very easily, and I can move the money from the companies that I've sold into companies that are much more compelling. So for similar return profile also, where the returns were similar, but really the comfort was less with some companies, was also able to improve the portfolio composition into companies where we have a lot more comfort. And it is very important in these times not to keep focusing on the media. I remember anytime, like recently when the India-Pakistan conflict broke out, I was looking at the media a lot more to learn more. But frankly, the media was extremely biased one way or the other. There was no objective measure, right? But at this point, when you're looking bottom up, looking at what companies' results are, if you're looking at buying companies, that is a much more objective measure, because that tells you what the reality of the company is for the previous quarter. Also, always remember the incentive of a media house or a media story. And their incentive is to focus on the eyeballs and get more eyeballs. And remember that negative news or shock news or a shock sells much more than a good news. And so, therefore, you will see a lot of breaking news sort of emails coming to you, a lot of items which will immediately grab you. But as you go through the content, you will realize that the headline may or may not correlate with the content. And so always be aware of why somebody is putting out the news article that they are putting. And remember that media may not be reflecting the true reality. This is true both, by the way, both of the traditional media as well as the social media, maybe more in social media. So I'm not talking negative about traditional media. I think all media have the same issue. But ultimately, how it all came out, and the portfolio performed exceptionally well after initial fall, but for the year it was up more than 50%. I think the indices were also up meaningfully. But remember, there were many people who got so shocked by the whole idea of COVID that they just came out and became and went into cash. And I know quite a few of them. And so it is very important to realize that daily, weekly, monthly, quarterly returns are meaningless. And that is not something that one should try to optimize for. So, of course, there are difficult times, there are good times, but there are certain things that in investing never changes. What are some of those things? One is that whenever you're investing, one should look at the expected return, which is what is the price? What do I think the price to be based on my assessment of the business, and figure out what is the expected return. And then invest if the expected return is much higher than whatever rate you're looking for. The second thing is that being an equity investor, remember, is being a part owner of the business. Now, you are a partner in that business. You have no say in the business because you are just a small investor. But if you bring in that ownership mindset that this is my business, I should understand as well as the person running it, I think you will have a very different mindset and you will not have as much concern about the market prices moving up and down as it is as compared to how the business is moving up or down. The other thing to remember is that successful track records are built up over the long term. There's so many investors that I come across who, in the media or in terms of how they position themselves, they talk a very good game, but they don't deliver a good game, right? And so it is much more important when you're looking at track records not to look at the short term. And I presented only a 3.75 years, so that's not a long-term track record. But you look at what the individual was doing, how they were investing, why did they come out, are they financially independent? All those things matter a lot. So if you think long term and you ignore the short term noise, then it is those track records that tell you whether the approach is the right approach or not. When you're investing, always invest in good businesses where the management is shareholder aligned. But also remember that many times when it's a good business, it is also valued as a good business, meaning that it is not available at a discount. And therefore, it is very hard for an investor not to control themselves and say, like, buy the best business, a secular business, but if it trades at 50 times and it grows 10%, is that good stock? So many times people confuse a good business for a good stock when that is not the case. Understand that volatility is not risk from an investing perspective. So as I mentioned in my initial description of myself, I used to be in risk management and I've done risk management at many places, including JP Morgan, Bank of America, Goldman Sachs. But the risk management that most of these Wall Street firms do is for the trading book or for the hedge funds, where the hedge funds are into trading on a very regular basis. If you are a long-term investor, then volatility is not risk for you. Risk is permanent loss of capital. And volatility is something that is driven much more by demand supply. So if you understand that and you therefore change your mindset from, oh, the stock is down, it's very risky, to, oh, stock is down, maybe there's an opportunity. I think that will change your mindset and will allow you to benefit from what is perceived by people as risk. And that is really taking advantage of the stock market that is out there. Now, remember that stock market is one of the arenas where it is very easy for anybody to compete. You just open a brokerage account, a trading account, and you are set. And so, unless you have a competitive advantage, unless you know why you succeed, it is very, very difficult to succeed. And as I said, 80% of the fund managers do not even beat S&P 500, right? Which is a passive index. If they cannot beat it, I think one of the questions one I always have to ask is, what is it that you bring to the table and why do you succeed? And does your track record tell you that you have some insight, some capabilities that allow you to succeed, and try to figure that out? As I mentioned earlier in the presentation, for me, it is technology and finance. But that doesn't mean that is what will continue. So we are always looking for new areas where we have competitive advantage. So sector-wise, it said these two, but really from a mindset perspective, our competitive advantage is long-term investing and knowing that many things that are understood as perceived wisdom are not really what plays out in the market, right? Like volatility is a risk, for example, or like diversification for its own sake, right? Or just growing the AUM without looking at the type of investors. All those things are what makes us resilient, what allows us to actually do well over time, because we know many other people are not focusing on those type of things, which is the working with the right investors. So the right investors allow you to follow your approach when others will no more be able to follow that because the markets are making them nervous. And on investing, I will make this quote, which is, pessimists sound smart, but it is the optimists that make money. And if you look at all the billionaires out there in the world, you will notice that most of them are very optimistic about the future. And it is the optimist who will find new opportunities and who will pursue those, while pessimist might hide in the bunker saying a new world war is coming, right? So it is very important to understand that the world continue to become better and more prosperous over time. And this is one of the best times that we are living in. That doesn't mean that everything will go up. I think some things will go up. And the whole nature of capital markets is that there will be evolution. And if you cannot adapt to the new changes, you will be sidelined. And so the ability to learn and participate in the new things on your terms, very important, on your terms, is really critical. So here I will just once again take a break, see if there are any questions around investing in good times, investing in bad times, what never changes. And then I want to go into the question that I'm occasionally asked, which is, you are sitting in the US. Why are you focusing on Indian equities? And what are you finding in Indian equities that is interesting to you, which may not be apparent to the other people? And I think this section is much more on the macro. So far I have talked more on the micro. What is investing? How do we invest? What is the result of our investing approach? And why do we succeed? And then how do we behave in both good times and bad times? Now I'm going to take a step back and talk more from a macro perspective of what we like about the India setup and the Indian equity setup. But before I do that, let me give you one more chance to see if you have any questions on any of the topics that we have discussed so far that you want to ask.
Hi, sir. So I have two questions for you. The first question is, so throughout this presentation, you have described a lot of qualitative factors to define the risk which you are taking. We even discussed 6 factors, but all of them seem qualitative to me. So how do you exactly quantify it? Especially you told hurdle rate will be increased, etc. So how do you actually quantify this?
Yeah, so unfortunately, there is the whole industry about quantifying risk, and unfortunately, risk. That is where we have got things like volatility and standard deviation and all that, right? As quantification of risk, but the real risk is if you don't understand, and the real risk is if you lose money. How do you quantify it? I think the only way to quantify that is if you have lost money, and how much have you lost vis-a-vis how the rest of the markets have done, right? That is the only quantification that makes sense if you are an investor, think about you run your own business, right? You run your own business where whatever business you have doesn't really matter. How do you quantify risk in running that business? Your quantification of that will be how much my top line moves around, how much my bottom line moves around. That is the quantification of risk, right? In that particular case. But if you are going to hold it over the long term and ultimately the trend line is up, how would you define the quantification? You need to think from that perspective, and the same perspective needs to be applied when you're looking at the stock market. The only difference is that in stock market, you can come in and out of the position if you want. And therefore, you have more advantage of investing in stocks. But other than that, being a part owner in a business means that if you take the business mindset, right, I think almost all investors will be better off. And I would encourage you to think what are the risks that you perceive then. And again, the risks will vary very much by the industry you are in. And therefore, the quantification of these things become very hard. And if you then have to bring all of that together, to me, it is very risky if you lose money, right? And therefore, and ultimately, the two rules of investing that Warren Buffett talks about: don't lose money, right? So if you lose money, it's very risky. And ultimately, that is the only quantification of risk that you can come up with if you're thinking long term.
And the second question was like, you mentioned that based on this, you have been changing your portfolio, like selling slowly as well as buying slowly. So that was one thing mentioned. So how do you actually decide whether uh, some stock is, like you mentioned, we should not lose money, but that is again a very subjective term. So you would say like this stock will lose more money than the other stock. So you would go for the other stock, as I could understand from your argument. So, how do you actually make that decision? And what has actually worked for you and what has not worked for you? Since you mentioned that you do a pre-mortem and not a post-mortem. So, having that foresight, how do you develop that? That was the other question.
Yeah, sorry, repeat the first part of your question again.
Yeah,
Pre-mortem. Yeah, is
how
fine.
has your portfolio changed? How has your portfolio changed? Uh, is that audible? Hello?
Yeah, no, I can hear you. So how is the portfolio? So when I say that we buy and sell slowly, the idea is not to say that we are buying and selling slowly, because the reason why I do that is because I feel that once I start a course of action, I have to put down clearly for myself why am I doing it, and as I put that down, either I will come up with more conviction in that, or I will figure out, no, this is the wrong step. So even if I am wrong, the mistake will not be a big mistake because I'm gradually doing it. But if on the other hand, that is the right course of action, then it allows me to move in that direction. Now, your question is, where will you lose more money and where will I lose less money? That will depend on going back to the expected return framework, right? Where what I have said is, we will come up with, given the price, given my expectation, what is the expected return. So when we are selling things, we are selling things where the returns are very low. Okay, very low means it could be in single digit percentage returns, or it could be even zero or negative, right? So we are basically starting to sell those positions, and the lower the return, more likely we are selling more aggressively those positions, right? And what are we buying? What we are buying are where the top of the stack. So every time when we're looking at our portfolio as well as the watch list, we are creating a forced rank of the all the positions that we are interested in. We are buying what is at the bottom, we are buying what is at the top, and we are selling what is at the bottom. And that is the process. But if there are multiple positions which are at the bottom because the market is exuberant, we are happy to keep selling all of them, but in a gradual manner. Because what does happen is, as you take a course of action, you might want to change it, and it is a lot easier to do it if you're doing it gradually. And the same is the case on the buying side. Now, going back to your second question, which is the pre-mortem, post-mortem, and what has worked for us or what has not worked for us. What has worked for us is buying companies or buying stocks which we considered in our mind was extremely cheap. Extremely cheap as defined again by expected return. So this whole expected return framework that I talked about is really the cornerstone of how we are buying or we are making changes in the portfolio, right? So if the position or the price is very cheap, the returns go up, and those are the things that we buy. So in general, not participating in fads, not participating in things that we don't understand is something that allows us to go into companies where the returns can be good. And so what has not worked is if we have gone into companies where the management was not giving us the comfort, right? What we have found is that if management does not give us the comfort, we will observe them for a longer period. In those situations, sometimes the opportunity might be missed, but we would rather miss an opportunity rather than participate in an opportunity where we think the management is shaky, dicey. And that could be because we don't understand them well, right? So it's not, remember, investing is about the future. Future is uncertain. We don't know what will happen. So we are working with many unknowns, including the business of how it will evolve. And so because of all of that, it is very important that we take a guarded approach. And so management and where we don't understand the business are the two areas where we have made mistakes. And therefore, we continue to try to improve our understanding of the businesses which we want to bring into our portfolio.
Thank you.
Any more question, please? Anyone?
Hello, sir.
Yeah.
So
Hello.
I have one question regarding since you actually said that you are investing from US into the Indian markets. I just want to know your views that how do you see the devaluation of Indian currency against the US dollar, and how it is actually a challenge for your returns you actually get from there.
That's a very good question. So, since inception till end of 2024, the Indian rupee has depreciated by around 3.9% annually. So, when I present you the annual returns, dollar returns of 25.8%, remember that those are dollar returns. So in rupee returns, those returns you can just add. It is not exact simple addition, but you can do a 25.8 plus 4, let's say. So in rupee terms, we have 29.8% rupee returns after fees, expenses, and Indian taxes, right? So it has reduced our dollar returns by the depreciation. Now, how is that a challenge? We think it is a challenge because we understand that rupee will devalue over time. We also think that the devaluation that has happened in the past, the devaluation rate may not continue at the same pace. Now, it won't necessarily hold in 1 year, 2 years, but over the next 10 years, my view is that the rupee may not devalue at the same pace that it has devalued in the last 10 years. And therefore, I believe that the market possibly is underestimating the or is overestimating the rupee devaluation in the next decade. And I think that may be a tailwind from that perspective. But overall, clearly it hurts our dollar returns because we invest in rupees. The rupee devalues every year by a certain amount, and therefore our dollar returns get hurt. We now, in general, the question that follows from that is, well, if the rupee devalues, why don't you hedge it, right? Why don't you hedge the INR depreciation? And the reason we don't is because the INR depreciation is pretty much reflected in the forward contracts that are available, which will allow us to hedge the rupee depreciation. And in addition, the cost of hedging is typically big enough that it is not worth our while. And given my opinion that over the long term, maybe the devaluation will slow down, we don't think it is worthwhile hedging it. And this is another example where we would rather take the volatility of the rupee devaluing rather than actually have a constant devaluation, which is much worse than what the reality might be.
Thank you, sir.
Any more question, please? So, Mr. Agarwal, no one is asking. So I will I would like
Yeah.
to ask one question.
Sure,
That is for
please.
my personal investment. So you are getting around 25% return, no, in Indian or in US term?
In dollar terms.
US dollars? Okay, US dollar. And what's return from S&P 500 there?
Yeah, it's 12.8, Professor Karmakar.
How much?
12.8 in the same period.
In the same period, 12.8. And you are getting 25%, fine?
Yeah,
So
12.7.
okay, so if you don't believe risk, so in future also, you will be able to beat the market in US.
So over the long term, Professor Karmakar, we believe that Indian equities will deliver better returns and we will deliver better than the Indian equities. So I do think that over the long term, I'm not saying every year, and you will see also every year we have not outperformed S&P, but over the long term, I think we will outperform. And that is the reason for existence.
No, that's fine. Now I am planning to invest to your company. So if you can assure me that okay, you will give just extra 5% from that S&P 500.
Yeah. So
Will
Professor
you
Karmakar,
agree? Then
yeah,
I will invest.
yeah. No,
I
so
will sell my portfolio here in Indian market.
so I
So
think
I
what
will get approximately 20 or 18 to 19% return. If it is certain, if you can assure, then obviously I will invest.
Yeah. So unfortunately, nobody can assure anything in the equity markets because if if I knew exactly that I will have it, then of course I will put all my money in this portfolio, right? The challenge with equity markets is that you don't know when those returns will come, and even here you will see that the fund returns have not been every year. We don't have 25 returns, right? One year was a banner year, and then other years were sort of single digit returns, right? 3 years. So there is no way anybody can assure because nobody can be God. And even God, there is an article, Professor Karmakar, that was published where it said even God will not do well if they were to invest in the stock market and they had full foresight. And the reason for that is from time to time, your portfolio will be down meaningfully. And at that point, what you will make a big difference in what the returns will be.
Okay, thank you. So now I think that you can continue your
Sure.
discussion because they are
Sure.
not asking.
Okay,
Since
no, I think
they
that's
didn't
good. I
ask,
think
that's why I thought that okay, let me ask some questions. That's
no, yeah, no, that's a good question, by the way. That's a great question. Okay, so now let me move to the why we think, and so this is I will also talk to Professor Karmakar about why I think Indian equities, why we are excited about Indian equities. So let me make the case for India and Indian equities. So let's first look at the GDP growth. So real GDP growth from calendar year 13 to 23. By the way, for all these charts, I've taken this information from different sources. The sources are mentioned at the bottom, right? So these are not things that I've necessarily um, calculated myself, but I've used from other sources, okay? So from calendar year 13 to 23, Indian economy did a 5.7% CAGR, which was the second fastest. China did 5.9%. When we look further out from calendar year 23 to 28, Indian economy is expected to do a 6.3% CAGR in real terms, while the next fastest will be Indonesia, and China is likely to be 3.9%, so far lower than India. So India's economy will be the fastest growing large economy. And then Indian economy is likely to become a 6 trillion economy by the end of financial year 30. Again, this is from CLSA. You can always question it's 6.6 trillion here. Let's assume 6 trillion. And in the process, India will overtake Germany and Japan to get there. And then Motilal Oswal is projecting that if India's economy can grow at 9.5% CAGR in dollar terms. Now, let's understand what a 9.5% CAGR in dollar terms means, right? So you can assume that there is a dollar inflation of around 2.5% to 3%, right? It has been a little bit higher. Maybe they are assuming 3%. They have not specified what that inflation of dollar they are assuming, but let's assume 3%. And then India's real GDP, if it can grow at 6.5%, then the in dollar terms, India's GDP will grow at 9.5% in dollar terms. And if it can grow at 9.5% for the next 25 years or next 23 years, then it will become a $30 trillion economy in financial year 47. Okay, and this is from a 4.1 trillion, which was in financial year 25. As some of you will know, India's economy is 4.2 trillion more recently, and I think there's a lot of talk about how India has become the fourth largest economy. So that is one, which is that we have a tailwind in terms of how the GDP growth will be over the next few decades, right? What will drive this growth is the demographics. Now, when we look at the demographics, there will be almost 179 million new working age population that will come in the next by 2045. Okay. And these are people which will be in the age cohort of 25 to 64. So this group as well. But there will be almost 179 million new working age people that will come in India. Compare that to China, where you will have 103 million people who will come out of the working age. Okay. Europe will have 48 million people who will come out of working age. Japan, we know, again, has the negative demographic dividend. And then US, depending on what happens with the immigration policy and so on, will have some growth. So clearly demographics is going to drive, and there are many other factors. One can talk about how well the demographic dividend will play out and all that, but this is one of the drivers that the working age population in India will grow meaningfully. Now, the other thing that we always talk about is the capex. Now, here is an example of the capex, capital expenditure by the state, by the center, and by the listed companies in India. One of the big issues that has happened in the past is that the government was doing a lot of heavy lifting, right? And you can see here that the center capex in financial year 25 was 10.5 trillion rupees, right? The state capex is around 7 trillion rupees. And for the first time in financial year 25, the listed companies, listed corporate capex has gone to 11 trillion. For the first time in a long time, the listed companies' capital expenditure has actually gone above that of the government, central government capital expenditure. Now, since most of you understand economics, you know that when a capex goes up, it has a much better multiplier effect, and that will also be a driver for the growth of India's economy. The other thing to understand is the debt to GDP. Okay, so if you look at the debt to GDP of different countries, you will notice in 2023, India is around, let's call it 170, 180% of the debt to GDP. And this includes all the hidden debt and all that. And that you will see that the growth in debt to GDP in India has not been that high. From, let's call it 150 to it has gone to 170, 180, right? You look at China, it was at a similar level in 2000, around 150 or less than 150, let's say 130. And now it is almost 270. So the debt to GDP in China has grown a lot. And so what has happened is the growth in economy, growth in GDP has come in a manner which is not as capital efficient. And therefore, you need a lot more capital to grow the same percentage. That is what China is going through. That is what US is going through. That is what most countries are going through, except for Brazil, where the debt to GDP is similar to India, but the growth is not that high, remember, right? So therefore, if your denominator, which is GDP, is going to grow much faster, right? Your debt to GDP growth, if at all, it might even shrink, but the growth will not be that high. And so from a macroeconomic debt to GDP perspective, India looks pretty good. The other thing to look at is the formalization. So one of the big issues with India is that we don't get enough taxes. And one of the ways of measuring that is how many tax filers are there in India. So you can look from financial year 2012, where India had 31 million tax filers, and now it has become 80 million, right? But interestingly enough, since COVID, the number of tax filers have not gone up as much. But since 2012-13, it has almost 2.5 times. So the number of tax filers are going up. We all understand that formalization is increasing in the economy, and that will also be a driver because government will get more revenue. They will put that revenue into capex, and that will allow the economy to grow as well. The other very interesting thing is how well the capital is used. How do you measure that? You measure that through return on capital. And here is the return on equity of listed companies in India, and it is over the last 25 years. what you will notice is that India, most of these listed companies have a double-digit return on equity, even during difficult times. Except for COVID, pretty much it has been in the 10% plus range. Average would be somewhere between 10 to 15%, right? It fell a lot during COVID, and it was actually on a downward trajectory for all of 2010s. And then now in the 2020s, it has been on a upward trajectory, right? And if you look at the return on equity of Indian companies globally, right, you will see that US has around a 20% return on equity, while India is around 16%, and it is the second best in terms of return on equity. And how a return on equity defines how well your is basically tells you how well a company is utilizing the capital that it has, right? Higher the return on equity, higher is the profitability for the same amount of capital, right? And India that way is very, very efficient. You can see on the right hand side is Japan at 9%, right? And so higher the return on equity, the less capital they need from outside sources to be able to grow the company. And so that is one of the reasons why Indian companies can grow without necessarily having a lot of capital and diluting the existing shareholders. At this stage, of course, we have a big IPO boom and a QIP boom, and we can talk about it if there's a question. But this is the reason why Indian stock market gets good multiples, because the return on capital in India is much higher than in most places. You can see China is 11%, for example, here, right? Now, I mentioned that India's GDP will become $30 trillion by financial year 47, as per Motilal Oswal. But they also say that if that turns out, then the domestic savings between now and financial year 49, so they've changed the number of years here, but is a very significant $126 trillion, right? So what effectively that is doing is that the amount of savings potential that India will produce in the next 25 years is a very, very significant portion of 126 trillion versus a 14 trillion in the last 10 years, 20 years, whatever that is, right? So therefore, the amount of savings that will be put to work in India is going to be very meaningful over the next 25 years. Now, where will all these savings go? So this is a chart of how Indians allocate their savings. And Professor Karmaka talked about his portfolio. Professor Karmaka, you should tell us whether you have more than this or less than this. I'm just joking. But effectively, most households put their money in real estate, right? So 50.7% of their savings goes into real estate property. 16%, 15% goes into gold, 13% bank deposits, 5% insurance funds, and so on. And only 6.9% is equities. Okay, this is as of financial year 24. And you will see that this 6.9% used to be only 2.2% in financial year 2013. So effectively what you have seen is a lot more savings are moving into equities over time. And remember, I mentioned in the previous slide that the savings potential in the next 25 years for Indian households is almost 126 trillion. So if that 126 trillion moves at this 6.9% additional savings, right? 126 trillion dollars. If it moves into the equity market, you can see how much potential flow will come into equity market from Indian households over the next 25 years. And you're already starting to see some of that flow, right? So over the last few years, you are seeing how the domestic institutional investors' equity has been increasingly coming into the Indian equity market. A very blatant example of what has happened recently is look at what the whole tariff situation that came out. Given that US talked about a 25% tariff on India, and we'll have a separate section on tariff, one would have thought that the Indian equity market will fall dramatically. But it did not, because the inflow that is coming from Indian households, either directly or through mutual funds or insurance or whatever, is good enough to offset some of the money that is being pulled out of the Indian equity market. So Indian flows are becoming very meaningful, and they are able to withstand the outflows that might be there from other sources. And as I said, the allocation right now of Indian household to equities is only 6.9%. If you compare similar allocation for other countries, US is around 40%. So in the next, let's call it 2 decades, can this flow or can this percentage allocation, which is 6.9%, can it go to 20%? I think the probability is very high that in the next 2 decades, we are as in Indian households have 20% plus of their savings into equities. Why? Because equities is one of the better performing asset classes in India. In addition, what people don't realize, and this is interesting because I get a lot of questions around this, and I think it was asked in this class as well, that, well, what is the depreciation of Indian rupee, right? And ultimately it hurts when you're looking at the dollar returns. Obviously it does, right? But if we account for the depreciation of rupee, and this accounts, so because these returns are in dollar terms, and they are the returns of BSE 500 companies in dollar terms, right? And what you will notice is over a 5-year, 10-year, 15-year, and 20-year period, long periods, not short term, right? You will see that Indian equities, as reflected by BSE 500, have delivered in all these periods a double-digit return. I should grant you here that the time frame when it was taken was September 24th, when Indian markets peaked. So I think to that extent, maybe it looks a little inflated, but not very significant if you look for a 15 or 20-year period, because it will not have a very meaningful difference. Now, when you compare it to other countries, and we have Indonesia, Taiwan, some of the other emerging markets, and then we also have S&P 500 here. What you will notice is that S&P 500 versus BSE 500 in dollar terms have a similar return profile. Sometimes S&P 500 is higher, sometimes it is lower, but on the whole, you will see that they have similar profile returns, right? And so what I'm trying to emphasize here is even accounting for the INR depreciation, in dollar terms, we get in the same ballpark of around a 10% plus minus return in dollar terms. And assuming 3 to 4% depreciation of INR, you say 13, 14% INR returns is what Indian equity market, as reflected by BSE 500, has done, which is among the best in the world. You can see China here, over 20 years is 7.4%. And that was a comparison I used to get a lot. It has come down a lot more recently because Chinese stock market have not done as well. And you can see here over 5, 10, 15, 20 different time periods. But I remember in early or late 2010s, that was the only game in town, which was China, right? And so it was very hard for anybody to think about anything but China. And right now, nobody really talks about China.
Mr. Arnold, one question. Just you are showing here that BSE 500 is giving 13.6% return over last 20 years. But the return on equity in US, it was much higher than that of in India. But here the picture is different. So why it is not reflected? Because in US, return on equity is higher. So where it is going? Because their return on this S&P is lower than that of BSE 500. Just the reverse. So,
so return on equity,
your argument.
Return on equity, Professor Karmakar, here, these are for 2025 forecasts. So these, first of all, we don't know over a 20-year period what the return on equity has been.
Achha, this is only for 1 year. This is only for 1 year. Okay. I thought this was also for average.
No. I mean, I think we don't have that data, but I think we have return on equity of Indian companies over 25 years. But we don't have return on equity of US companies over 25 years.
Over 25 years.
The second thing also is that the growth rate of listed companies in India is much higher than the growth rate of the listed companies in the US. But US also have companies which allocate that equity in a very, or capital in a very good manner.
But last year, if you see, it is around 20%, no? Return on equity. So it should be reflected in their GDP also. But GDP rate was that much?
No. So Professor Karmakar, return on equity is saying if I'm taking $100, right, I am able to return a profit of 19.5 in the US, and I'm able to get a $16 in India, right? That may not necessarily correlate with the GDP growth rate, or it will not even correlate with the profit growth rate of the corresponding companies, because what happens in many cases is that these companies may not have enough growth opportunities. And so what they are doing is they're returning that capital back either through buyback or dividends rather than growing.
Okay, okay,
Yeah.
understood.
Okay. So this is the historical returns of India versus other markets. And then moving on, so I've given you a little bit of the context of the India's macro from a GDP perspective. Now let's look from an Indian equities perspective. Sorry, was there a question?
Any question you want to ask?
Hello, sir. Sir, on slide number 48, you mentioned that India's household wealth in equities is quite low, but the comparison that you are making is from the developed nations. So, like in the developing nations, generally the risk appetite of people regarding the equities and their money, especially, is quite low. So, isn't this reflective of that instead of the fact that India has more potential?
I think that's a very fair point. And that is why I was saying over the next few decades, because over the next few decades, I think India's economy, as reflected by the growth rate and per capita GDP, I think we will nowhere be close to a US or a UK. But I think you will start moving closer in terms of having a Singapore or possibly a South Korea. We don't have either of those here. But irrespective, I think what has happened, which I think is this one, right, which is 2.2 to 6.9, in my view, which is in one decade, three times in terms of allocation to equities, is because as a fund manager, I increasingly see people who are very conservative increasingly realize that rather than putting a lot of money into bank deposits or into real estate where they're buying second house or third house, why not invest in a better productive asset like equities? What is of course important is to have the right mindset and so on. So I would not be surprised if in the next 2 decades it is at least three times from here, even if it does not get into the 50 or 40% that we talked about for the US. Because remember, one of the things which I feel as I compare people in different countries, I feel that Indians are quite good in terms of the financial matters. Indians are also very good in terms of the savings, right? But they traditionally had a lot of concern with how the system works, how the financial system works, how are the controls there. And I think with the success in the last few decades of the financial system, there is an increasing realization that there is one place that people need to be there. And I'm seeing more and more people start asking that question, start getting interested. So I definitely have no doubt that it will keep moving up. How fast it will move up will depend on their own comfort and their own financial situation.
Uh, so I had a question. So if we look at the Indian currency, Indian rupee, it has been depreciating by around 3 to 4% per year for the past several years. So if we take that into consideration, wouldn't it make sense to, diversify into the US equities, given that, in the Indian equity market, you would have to get somewhere around 10 to 14% of the return year on year basis, whereas for the US equities, that's only 10 of the currency depreciation as well. So to diversifying equities for the investors be more lucrative from that point of view.
Yeah, so these returns are reflecting the currency depreciation as well, right? Because these are dollar returns. And so when I say BSE 500, ultimately BSE 500 will give you returns in rupee terms. And then somebody has taken the pains to do what was the INR value 20 years back, what is the value today, and therefore what is the dollar returns. So first of all, first point is that this accounts for the depreciation. Now, the second question is why not invest in US equities? And what I was mentioning earlier, most of my investors are US investors. So they're anyway investing into S&P 500 as a base case. What then they are saying is beyond S&P 500, if I have to diversify, and we will come to this, but S&P 500 is not a cheap index. Where you start matters a whole lot, right? And S&P 500 right now is trading in the 20s as well, as does Nifty 50. But S&P 500 will not grow as fast as compared to Nifty 50 because India's GDP will grow and therefore the whole ecosystem will grow faster, while US GDP will grow at 2 to 3%. India's GDP will grow at 6 to 7%. Right there's a difference of around 4%. Right, and so that growth rate ultimately will translate into a higher growth rate for the listed companies. And when you have higher growth rate, you will obviously be willing to pay higher valuation for that growth that you will see in the future. Right, and so I think when you are saying whether shouldn't we be investing into S&P 500, this you need to think from what investor you're talking about. Our investor base is primarily US investors. US investors, almost 100% of their equities possibly is in the equity market of US. And they're saying, beyond equity markets of US, what else can I invest in? And that is where the Indian equity markets come.
Thank you, sir. Makes sense. So I had a follow-up question to that. So yeah, I get your point that since your investors are majorly US citizens, so it makes sense for them to diversify into the Indian equities. But another theme or investment theme that I could think of is, let's say the semiconductor industry, or the data center play that's going on from the past 1 year, or the generative AI. So those are some of the investment themes which are, prevalent or more susceptible to higher growth rates in those markets vis-a-vis if we compare to the Indian markets. So from that point of view, also if we wouldn't the growth, let's say S&P, or even the smaller companies who are not a part of S&P index, would grow at a faster pace compared to their subparts in the Indian context.
Yeah, so sorry, your voice break in between, but I think the gist of the question is there are subsegments which can grow faster than Indian equities. Why not invest in that, right?
Any more question, please?
Okay, just answering that question, I think the subsegments can grow faster, and so I don't want to disagree with that. But the subsegments don't become your whole portfolio, right? You might allocate a portion of your portfolio to those subsegments. The more comfortable you are, the more you will allocate. But it is important to realize that when Nasdaq was doing very well, everybody wanted to be in Nasdaq, and Nasdaq then fell 60, 70, 80%, right? And this is the 2000s we are talking about. So the subsegments can be a portion of your portfolio, and how big a portion will depend on how comfortable are you with that subsegment. And everybody will have their own comfort level, huh? And so therefore they will decide how much they want to allocate. And again, this is not to say that everybody should invest, though I think that everybody should, into Indian equities, but the allocation will again depend on what is their comfort with what I'm talking about here, right? Okay, so I think yeah,
question.
sure.
So these days, many investors are concerned about the green finance or green investment. So they want to see in different studies that green portfolios are sometimes giving better return, at least the risk-adjusted return. So are you considering these green or brown assets in your portfolio?
Yeah, so Professor Karmakar, our approach is we will consider all opportunities as long as we can understand, but they have to come in the portfolio based on the merit of their expected return versus risk. And risk in our case is our understanding of the business management and how the past track record is. We don't want to add additional color of whether it is a green company or a brown company, as long as it is good company with good management, good business prospects, good return expectations. We are very happy to have them. But we don't select an idea based on additional considerations.
Yeah, but that's true. Recently, that from from European countries, many fathers of the church, they are telling those who are the Catholic investors, so they in green funds only.
Yeah.
So the Pope also in that Italy. So recently, that movement has started. While investing your fund, you should consider that which companies ESG score he has given that rule, and in fact, from 2002, top 1,000 companies have started reporting their ESG score. So, of course, before that, it was not possible to identify which company is green or which is brown, this and that, but now it is possible. So many investors or many portfolio managers abroad considering this point, these factors.
Yeah. So you are absolutely right, Professor Karmakar. We keep having investors who come to us and say, listen, what are your parameters of investing? And we always tell them that ESG is something that we will consider in terms of the overall aspects, which is the business, the management, the past track record, expected return. But I don't want to add ESG as a factor. If you want us to report and say, listen, how many companies will fulfill your ESG criteria, we could possibly come up with that, but that would not be a filtering. And typically, many of these funds or many of these investors are saying, no, only do ESG. And I will also tell you that ESG was a much bigger buzzword a few years back. I think to some extent, since the new US president, ESG has, at least in the US, taken a little bit of a negative connotation, as you might have seen from many universities. The whole DEI conversation that you might have heard is really hurting them. And I would not be surprised. This whole ESG thing started in the Europe, and I think as Europe tries to start becoming more competitive, they might also want to consider other aspects of it rather than go only on ESG. And so they might very well broaden the mandate. But this thing has been going on for many, many years. And as I was working on my fund, we keep having those conversations with the investors.
Okay, thank you. So I think it's 5 to 11 already. I don't know people have taken their dinner or not. But I took before coming to the class.
So I think I will skip because frankly there's a lot of stuff here, but I will just leave it here because we are at 3 hour mark. If anybody has interest in what is interesting, Professor Karmakar, is I think the whole case for Indian equities generated a lot of good questions, which is always good to see. Maybe I should put this in the beginning of the presentation going forward and have some good dialogue going then maybe, but we'll figure it out. But if there are more questions, feel free to reach out. Here are my contact details. The name of the company, Dudarshi Advisors. This is a general partner to the fund. You can reach out on this email. We have a lot of good content on YouTube. So on youtube.com/@Dudarshi Advisors is our YouTube channel. I have appeared on many different YouTube or many different channels, television channels. You will see that I present in different forums, so you can see some of the presentations. You can go to our website, dudarshiadvisors.com, or just write to us. And I'm also available on Twitter or LinkedIn. Feel free to reach out. I will look forward to posting this recording, which is why I wanted to record it. So that we can have other people benefit from it as well. So I look forward to posting it, and feel free to connect with me. If you are more interested in investing, if you are finding some good ideas, do share. That is always an additional benefit. But I think I always look forward to presenting at Professor Karmakar's class. I think it's good dialogue, a lot of good, interesting, deep questions. Helps me think about what I'm saying, is it right or not, and reflect and improve. So I think thank you for your participation. I think a lot of good questions. And this time, Professor Karmakar also did a lot of class participation by asking questions. So that's fantastic. Thank you.
Thank you, sir. On behalf of all of us, I extend a heartfelt thank you to Mr. Rajeev Agarwal, CFA, for an insightful and engaging session. Sir, your emphasis on the fundamentals, from the power of compounding to the importance of long-term investment, gave us a really strong foundation to think like a disciplined investor. Your guidance on what to focus, such as management quality and what to avoid, these were really helpful. We also appreciate your candid like sharing of your strategy, portfolio approach. It really brought real world context to everything that we are learning. And of course, your golden rule that don't lose money and don't forget the rule number one is a lesson that will always stays with us. Thank you once again for your time, your wisdom, and your generosity. Thank you, sir.
Thank you very much.
So, Mr. Agrawal, I will share your mail ID with my students. So if they have that query, then they will ask later on.
Sure.
Okay.
Sounds very good. Thank you. Have a good day. Bye.